Hey everyone, welcome to another episode of Investing Counterpoint. Daniel, how are things going today?
It's going exciting. There's not a boring day now. It's like living in history. I'm not sure it's all pleasant, but it's certainly not boring.
Well, today we're going to talk about housing and the housing market. We've been kind of teasing this for a couple of weeks now, but we were supposed to do this podcast yesterday, and fortunately, we waited to today because we had some interesting comments from Powell that I think we can lead off the discussion with that today.
Yeah, definitely. As a reminder, our show, Investing Counterpoint, is mostly for financial advisors to help you explain risk to your clients. Because me and Jan, we have worked with risk management models. We built software for risk managers. We worked with risk managers. Jan was a big time risk manager. I've done a lot of scientific work. So what we're trying to do with this show is to help you become an expert, and not just an expert in that you do a better job for your clients, though that's probably the most important thing, but also an expert in that you can verbalize it and you can explain to your clients what's going on. You can calm them down, because psychology is just about the biggest part of risk, right? Or at least it's half and half, right?
Absolutely, yeah. I love that you call me a big time risk manager. I mean, that's the phrase that I want to. If we can just capture that from this and just put that
to me, and I'm being very, very sincere. So I don't mean it as in Hollywood popular risk manager, but I don't know if there are too many of those. But anyway, so lots of respect. I have a lot of respect for you.
Thank you.
Now, going from psychology to Powell's speech. It's all psychology, right? 95% of what the Fed does is words. I mean, the actual policy is less than 5%, I would say. It's like Ronald Reagan once said, I don't know how you can do this job, meaning a president, not when you're not an actor.
Right.
I think this goes like double for the Fed. You have to be maybe not an actor. I would rephrase it and say, I don't know how you're a Fed chairman if you're not a poker player, because all it is a lot of bluffing. Honestly, that's what it seems to me. And today, the whole thing, right? Nobody's watching. It's becoming a little surreal. Before we talk about the consequence of what he said, it's becoming a little surreal. Almost nobody cares about the economy. Nobody cares about anything real anymore. The most real thing we care about is Chairman Powell, what he says. And so he said today, I think that it's all like a scale from dovish to hawkish. All the algorithms and people try to do is place the words on that scale. And then really, literally, it could be 49%. Or 51%, which is totally indistinguishable, but the consequence will be absolutely opposite. So when he first said what he said, and really he emphasized that, he said two things. He said, basically we have the history teaches us that we cannot let go too soon. So that's hawkish, that we have to fight inflation to the bitter end. And you and I have said that all along, right? Though risk management is not about prediction, to entertain you, we talk about a little bit about predictions, but that's not the main thing of the show. So we said time and again that Fed is unlikely to back down here. It's just very, very implausible. If they do, the consequences for their credibility, which is already low, will be very dire. And the Fed is not backing down. That's what Powell said. We're not backing down. We're going forward. Yet he stopped short of pronouncing the hike. He didn't say that it's going to be 3 quarters. He said, no, we're going to look at the totality of the data. Right.
Well, and that's kind of where we had a little bit of discussion previously. It wasn't about the direction, right? It was about the magnitude. And I think that's what gets parsed in these things. Like, is it going to be a quarter point? Is it going to be 3/4 point? Is it going to be a whole percentage? Because you get things like, his exact quote, and that's what I was looking at over here was, it requires using our tools forcefully to bring demand and supply into better balance. So there's the word forcefully, like you said, these words are not accidents. The Fed doesn't come out and say,
Yeah.
I'm thinking we're really going to have to stomp on this thing. He doesn't say that. That's not the way it's every word is measured. When you read those releases, if there's a word added, that is parsed to no end by pundits, by economists, by investors. And so the way that he's talking here about forcefully, there's no question about the direction, but what does forcefully mean? Does that mean he was leaning towards a quarter point? Now he's leaning at a half point to a 3/4 point. So the direction is clear. But again, what does forcefully mean versus leaving that word out?
And just to be clear, strictly speaking, the Fed is not even talking about fighting inflation, really. They're talking about fighting inflation, but they're not. I'll explain what I mean. In order to kill inflation historically, and I read a note. Unfortunately, I forgot the name of the analyst. I should really attribute those things. I will try to remember for next time. But it was an interesting research note where an analyst looked at different periods of inflation, what the Fed did, and apparently Fed never stopped. When inflation got above a certain level, the Fed never stopped until the funds rate was above the inflation, and not trivially, maybe by 1 or 2%.
Yeah, right.
So
they undershoot.
So when the Fed says we're going to fight inflation, we're going to go up all the way to 3.5%. That doesn't make sense because inflation even now is at 7.5 or something like that. So I think what they mean is that we know that the markets are extremely over levered. We know that the markets, there are many problems in the markets, and that we don't have to go all the way to the economical, theoretical level. Even at 3.5%, the markets will break, and deflation will ensue, and the deflation will do the rest for us. So it's not like we're raising an interest rate to normally cool the economy. It's like, no, we're going to break it a little. And he actually said some of these things like there's pain ahead. I think he used the word pain.
You did use the word pain.
I think that's
some
what he
pain.
implies. It's like we were not, in a normal type of scenario, when inflation gets a little bit out of control, theoretically at least, right? It never works, but you try to cool it. But when he says pain, what he means is that we're going to break it. We're just going to break it a little bit, right? And so my thought is they're not going to break it a little. They're going to break it more. But that's the news for you. So when you hear there's a lot of white noise, when you as a financial advisor, you see the markets, like there was a rally recently, right? That was completely unexpected for most people. It happens, but you have to keep an eye on the long-term picture and how you stress test it. That's kind of our thesis, right, that we're getting across on the show. In my mind, going back to a few episodes, we have a stress test in Portfolio Crash Testing, which is a software we sell to financial advisors to do just this, right? You don't have to use it to listen to the show, but we have a scenario called Fed keeps hiking and doesn't stop. It's like literally some long sentence like that. That is what we're living through. All these other things are blips, and it doesn't mean that it's necessarily going to happen, but it is definitely one of the scenarios you should have on your radar. You should stress test your clients' portfolios and understand where they will land when this quote unquote pain ensues, right? There will be pain, and Powell admitted it, right? I'm not even talking about, we're going to have next episode, we're talking about Europe. Europe is crumbling, right, in many ways. Yeah. But that cannot not have an effect on the US as well. But for today, what you take out of the Powell speech is that, look, you need to have this thing on your radar. You need to have different types of scenarios for the end game when the Fed is done with what they're trying to do. And that is only going to happen when there's pain. And so you need to build a portfolio it's not riskless, right? It's risky, but you have to spend risk in proper places. So that's what we're going to, try to do. Look in the episode if you're curious. There was an episode, we'll put it below the video, hopefully. The prior episode on Fed keeps hiking, one of the scenarios. We actually showed it in the software in different contributions on how it looks. But do you have anything else to add? Is there any other kind of tangent that you want to touch here?
Well, not directly as it relates to the Fed, because our topic originally today was we were talking about the housing market, and one of these things is what we've seen is a really I'll say robust housing market, and maybe too robust. I'm not sure that it lives up to the bubble level, of 2008. I personally don't think it does, but I've heard relationships to that. I prepared a couple slides kind of showing what this means, and I'll try to talk this through for podcast people. But when we talk about the real estate market, that's very tied to people's. Again, we're talking about psychology. If your house is going down, if people's jobs are at risk, if the housing market is going down, this is all part of investor psychology. And there's retail investors and professional investors, but all of this stuff works into the system, right? People have less money. They slow down their spending. That impacts the companies. That impacts the economy. That impacts the market. So if we talk about housing as one of these components, it's a little bit more difficult to test a housing decline or a housing crash, but we're gonna talk about some of the factors that we could potentially use here. But why don't I go into the slides and just kind of talk about what's happening in the housing market. So I prepared a few slides for this, and what I wanted to show, and I'll try to talk through this for people that are listening to on podcasts. But it's one of the these are when we're talking about the housing market being potentially ripe for a decline or at least a stabilization. Here's some of the data that I'm looking at to make that point. What we see here is a chart of the 30-year mortgage rates over the last year. And what we're showing is that in the US, mortgage rates over the last year have gone up rapidly starting in January of 2022 to the present time. And over the last year, that's been about 2.7% increase in mortgage rates. And what that means is that's an increase in 37% of a principal payment on a conforming mortgage. That's
huge.
It's huge. So instead of paying about $1,300 for a $300,000 loan, which is about the average for an American mortgage, now an American would have to pay almost $1,800. So you're talking about a $500, it's just less than a $500 difference in a monthly mortgage payment on $1,200 to $1,800. I mean, $1,300 to $1,800. That's a big difference. That's a massive difference for people, in terms of affordability.
And the type of an economy we have today, especially.
Exactly. And when you think about and this is the housing component of CPI. So this is what's being measured, right? So this is what's being measured by, getting into the inflation component. And I want to talk a little bit about this because I have another slide after this. We have this increase in the housing component of CPI. Now, if you look at what happened in 2008, so this is just a chart going back as far as I could go, but if you look at 2008, the component of CPI is barely a blip in terms of a decline. We know that real housing prices declined drastically in 2008, but it's not really picked up.
Why is that? Is that because everything else declined as well, or was there?
I think that I think
it doesn't make sense actually to me. I would expect it to have a little.
I did too, and that's kind of what I wanted to point out. And it doesn't make a ton of sense to me either. But I think that it comes down to all the different measures that they have in the housing component of CPI and of how slow and how they normalize it. And so what you see is that really that didn't impact CPI at all on the downside in that 2008 period. And what you can see in the most recent time is that it's still going up rapidly. I mean, this last reading is from last month, and that is the high. So according to the CPI component, there isn't any decrease in housing prices, and that's owner's equivalent rents. I mean, there's all kinds of things in this housing component of CPI. There's a few of them. Okay, so if you look at this though, this is the Federal Housing Finance Agency Housing Price Index. And this shows more what you would expect to see, although I would argue this is still a little bit light in the 2008-9 period of about a 19% decrease in housing prices. So this is the FHFA Housing Price Index. A little more realistic, but even that one is just going up like there's no tomorrow at the most recent reading.
Can it be just because of the reporting lag that at the bottom point it would probably fell like 40% or in some cases more, but then by the time it was reported already, they had the 2009 and the 0% rate and so on.
Well, this part I'm a little bit less worried about. I think that there's probably, I think there's some lag. I think there's some data issues, and I think that there's some markets that were down 40%. Some were down. I mean, a 20% loss in your housing is a pretty big decrease. And as you can see, this chart goes one direction. This is from 1975. It goes one direction. So a loss of 20% is a big deal in this chart. So if we see something similar happen today, I mean, there's really only one period of loss here, of one significant period of loss, and that's a 2008 to 2012 roughly period. And that's a total of a 20% or 19% loss. So it's a very small. So again, a lot of these components, may not accurately reflect an individual market. So different markets throughout the U.S. are also going to have different levels of pain. But one of the things that will drive this are these inventories. And one of the things that I think is that we're going to have to see these inventories tick up. And so what you can see on this graphic is that we're kind of at, near a record low in terms of U.S. inventories, U.S. home inventories. So I don't think that we're at the point where housing is going to roll over completely, even though it's more expensive, because we don't have a lot of people trying to get out of these homes according to this. I think that's an important component. But, and the last component that I'm going to show here is a U.S. mortgage default on first mortgages. This is still really, really low. So I think before we start to see defaults and pricing rolling over here, we're going to have to see some increases in both defaults and inventories, because people are going to try to be getting out of their house. What's that?
I hope not, but yeah.
Well, yeah, exactly.
But there's these other two charts, actually, these are very counterintuitive, but actually one of the piece of good news, maybe the first piece of good news I've seen in days when looking at data, because the mortgage rate chart is really, really scary. You look at that and you think, well, what is it going to mean for families, for middle class, for everybody else? And it looks really scary, but this suggests that, but so basically the entry point is really high, which is sad for younger people.
Exactly.
But those people who own a house, they're kind of sticking to it because they got it when the rates were low. So their payments are still manageable despite all the difficulties.
Just to take it down into a micro, very, very micro, like I would love to sell my house and get a different one because I don't love my house, but my mortgage is so low that, trying to get something that's increased over all this time, trying to sell my house and get into something else, it's just like, well, just to do a lateral move and get the same exact mortgage would cost me, $2,000 a month more, you would actually go, you would have to go like inferior because exactly.
Right. It's like Alice and Beyond the Looking Glass. In this country, you have to run very fast just to stay in one place.
You do. Yeah. So we're going to be keeping our house, which is going to keep those inventories lower because we have such a good mortgage rate. Now, there's circumstances that you can't do that. You have to move and all these other things. But I'm thinking that there is some of that going on, like not selling because you don't have, people might like to cash out, but they have no place to go and they can't afford the mortgages at this point, which is why we've been seeing this kind of falling mortgage rate. But there are other indicators here too. Housing starts. I looked at some economist predictions. This was on Bloomberg as well. Through 2024, housing starts are predicted to fall each year, which means, that's an economic measure, right? They're not going to be able to sell as many houses. So housing starts are falling. The effect of cancellations on people pulling out of their contracts, it's going to cause these housing starts to fall. And that's, builders, that's part of those economic measures, buying building supplies, hiring construction workers. They're expecting new home sales to fall next year, but rebound in 2024. They have existing home sales falling versus 2021, and they're expecting building permits to fall. So this is all indicative of a slowing economy. And that's going to have to put, those things like decreasing the amount of inventory that comes on the market, both in, existing homes and in new homes. It's got to have some support of the, underneath pricing, even if it's expensive. So I'm not sure we can see a housing bubble, but I think that all of the other things around housing slowing is going to cause the economy to really kind of sputter a bit, coupled
And
with
it's not, I mean,
right?
it's not the only indicator. That's the thing. Like there are a lot of things pointing towards slower economy. I think it's really inevitable, and that's one of the, and that going back to Powell's speech, he talked about the pain. It's the pain that the Fed is going to inflict. They will argue that it has to be done, and maybe, but it has to be done because of what the Fed itself did before. So
Yeah.
it's definitely a tough situation for you as a financial advisor. If you're really well off, you have a lot of great wealthy clients, right? You're probably okay. But if you're trying to win new clients, you have to understand their situation. And the situation is that, especially younger people, they have all these, and you probably do, right? You as a financial advisor, the listeners, you see that. So what kind of portfolio do you build? Right? You have to basically, there's no hope for kind of a magic portfolio that will grow out of all these problems. There's not, right? There's no longer Bitcoin. There's no, you have to do robust risk management and manage expectations.
Well, that's that's the $1 million question at this point. Like, where do you go to hide? We've seen, we have no change in the yield curve shape over the last, since we did our last podcast. It has increased. It certainly has increased maybe 10 or 15 basis points. I'm not sure.
Weird looking yield curve.
It's that weird looking yield curve. I'll next time I'll put a shot in there in case people are still wondering about it. But it's still that weird. It's the exact same shape. It's kind of gone in parallel, keeping that weird shape. So we do still have this inversion where the 5-7 years higher than the 10-year. Now, what is that? When does that normalize? When does that catch up? But we do have this case where arguably you're going to be having increasing rates, which means falling bonds at the same time you have a falling market. So
so like there's no safety in your arbitrary 60-40 portfolio.
That's right.
You have to think of very specifically for types of scenarios that we might be facing, and you have to try to allocate some of your portfolio for each of those types of scenarios without killing its overall potential. So that's why I think we really focus on stress testing. People who want to summarize risk in one number, it is, I think it's I want to be kind, but it's kind of a foolish exercise, because the risk, there's so many facets to what's going on. And yes, we don't know the future, but summarizing it in one number is really impossible. Just look at a few episodes of what we discuss here. We really try to bring to you the conversations that a risk manager is having, right? That you're having as a financial advisor. And those conversations imply that you have to have a system, you have to be humble, and you can't try to summarize everything in one number. Yet you have to put together a portfolio that can be prepared to withstand at least most of these plausible scenarios. So I think that you have to stress test Fed tightening, because that's the driver.
Yeah.
As far as housing, what the charts that Jan showed, we have stress tests for housing specifically, for how like a housing collapse like 2008. I think what Jan showed suggests that I would not run that stress test right now. I would run stress tests on Fed tightening. I would run stress tests on emerging markets hard landing. That's our previous show. We're going to talk about Europe next show. The housing collapse is not the one I would stress test just based on this kind of data, because you don't want to be testing for everything. You want to have plausible 6, 7, 8 scenarios and build a portfolio. Be ready to discuss it with your prospects. So yeah, great. I mean, this is very interesting. Actually, it was eye-opening for me, the inventory chart specifically.
But the interesting thing is those are some numbers that you have to keep an eye on to see when housing, when that does start to hit on your radar. Because like you just said, Daniel, I think there are some things that would make more sense to be worried about before housing at this point. That said, I think housing is very low. I mean, I think that there's some danger in housing. I wouldn't, I'm not necessarily, just because I don't see the big risk in housing, I'm not advocating for everybody to go out and no, put their money into houses.
No. What I mean is like a stress scenario where you stress test for housing collapse is not the one that would be on my top 8 list.
That's right.
and that's what I would draw from this data. So there is some analysis here. You don't just like, people think that stress testing is arbitrary. Well, let's trust aliens landing and, destroying our civilization. Looks like it might be happening right now. But you have to be plausible, right? Plausible is important.
Absolutely. There's one more thing that I wanted to leave us with before we, before we jump, and this kind of ties into the next video a little bit that we're gonna do on Europe. But I found this, which I thought was really interesting, and this is the 5 gauges of property risk for OECD member countries. I thought this was really interesting because it does show, contrary to what I just showed, it shows a lot of red. So obviously red is bad in terms of the graphic, and blue is good. And this is going to be a little bit harder on a podcast.
Well, New Zealand makes sense to me. They turned that island into a prison. But
yeah.
Why would Hungary, Hungary, for all I know, and I have friends there, I mean, it's doing really well economically. It seems to be stable. Why would Hungary be up there?
And Portugal was one that I thought too. So the list is New Zealand, Czech Republic, Hungary, Austria, Canada, Portugal, and then
Australia,
the US.
Australia.
7.
It's Australia. It's not Austria.
Australia. I'm sorry. I said
Yeah,
Austria. Australia.
That makes sense to me too. Canada.
Canada too. Canada. Yeah. Portugal doesn't, but I don't know. I mean, Alex is in Portugal now. Maybe we'll get a report from him on how Portugal is doing.
Yeah, our colleagues traveling in Portugal.
Yeah, our colleague Alex is traveling in Portugal. What I do know is that a lot of people in the US are talking about buying property in Portugal, which could be buying up the prices, which could be, bidding up the prices, which could make it harder for, Portuguese nationals to afford. That could definitely be. But the interesting number that I thought in this chart from a US perspective, particularly, and for many countries, is the credit growth. And in the US, the credit growth, and I believe this is a year over year credit growth, is actually negative in the US of 2.5%, meaning that, there's more capacity to pay, in my view.
What is that? What does the credit growth mean? Is that like indebtedness of the households, or
that's yeah.
Debt load on the households?
Yeah. Yep. And so what you can see is that most of these are negative. Only New Zealand and the Czech Republic are positive in the top of the list here. So negative credit growth, meaning that the balance sheets of houses are in better shape. I think that is a for us to be talking about housing, I think that has to start going the other direction.
Right. This is an interesting chart. Yeah. So
it's an interesting chart, but this kind of gets into when we talk about price to rent ratio, home price to income ratio, being high and getting higher. I'd like to see some, I'm going to start to look for some time series charts of these, but I think this will get into
some see the dynamics. Yeah.
Yeah, this would be really interesting to look at in advance of our next talk on Europe, because a lot of these European housing markets are at the bottom here. And one I keep on reading about is Sweden, which is number 13 on the list. Everybody's talking about Sweden and the UK, which is number 15 on the list. How much difficulty their housing markets are in. According to this, they're far below the US in terms of risk. And what I just read was that the US wasn't at great risk. This article that accompanied this was talking about, the risk of the housing market in these top, particularly the top couple, but the top, countries here. So
interesting. Yeah, it definitely should analyze that.
Yeah, we should analyze it. But for all of you on the podcast, sorry about that last one.
A lot about energy, obviously, because European crisis is an energy and a credit crisis. I mean, Europe, as it was conceived, the Eurozone was always very, very frail. I mean, you cannot have countries with such different attitudes like, Germany and Italy in one union is very, very difficult. And so, all right. Well, thank you for your time.
Great.
We hope you enjoyed it. And you're going to get something useful, more importantly, to win over clients, to keep clients, to do better.
Yeah, because if they're worried about the housing market, I mean, maybe hopefully we give you a little bit of data to be able to talk about that. As always, do your own research, come to your own conclusions, because sometimes it's different than what you hear on your CNBC or Bloomberg TV or whatever you're watching.
Well, those shows mostly are about the trends. I mean, all you know is the trend, right?
Yeah.
We're trying to look
No
at
question.
that. That's why the show is called Counterpoint. Investing Counterpoint. All right. Thank you, everybody.
Excellent.
See you next week. Bye.